I'm going to go pretty quickly here. I wish I could be as distinguished as Debbie and sit down, but I'll stand up here for a minute and go through. First of all, too, I want to a shout out to some of my colleagues that I work with. I've had a unique opportunity the last year to work with a group at Chang Industrial that I admire so much, and it's just super fun for me to be reconnected with my friends in Jacksonville, and I'll tell you why here in a second, and kind of do a slow reveal. We're not supposed to do a slow reveal to that, but anyway, and also my research partner Carlton Robinson. Kudos to you. A long time. We use each other's theories and data, and love to collaborate with you. So who are you and why are you here today? So I'm going to assume and talk more to the would-be founder or entrepreneur than the angel investor today, but hopefully there's some insights on the investment side also for you. So who am I? In short, I'm both an academic and an investor and a former founder, and currently in a startup. And so I guess I check a lot of boxes. So what do I do as a lead strategist? Well, I assess really return on investment. And I do that with data. We heard everybody talk about that before. We use data and we evaluate the alternatives based on data. And at Chang Industrial, I have to fit in this team that does these incredible autonomous systems, factory redos, and now we're working with, I call it founders and Fortune 500 companies with an appetite for intellectual property and research and development. So you might have an appetite to make money. I know a lot of you in here have an appetite, but if you have an appetite to make a huge difference and find and create prototypes and commercialize something really great in the future, then you're potentially a customer. And so that's a little bit about me. In terms of credentials, I co-founded Above the Rim. We sold it to Reebok in 1994. So before anybody who was a non-shoe, we had the idea to be a basketball enthusiast brand, and then I had my own marketing firm. We were one of the largest in the Southern California market, and I was the 7th employee and the CMO of NetCentives. And so I have done, for you founders, I've done the roadshow, okay? And Credit Suisse took us public in 1999, 2000, and as a C-level executive for them, I saw my stock go from $100 a share down to about $14 a share. If you know 2000 and 2001, you have memory, you'll know what happened to that market. And we were the first digital currency. We used airline miles as that digital currency. And it was not taxed by the IRS before NetCentives came onto the market. But we put so many millions of miles into the system that the IRS caught on. And that kind of shut down, along with the internet blowing up, in other words, the internet incentive, e-commerce side of things at the time just didn't materialize as quickly as people had predicted, and that led to the demise of NetCentives. It's now a Harvard business case. I did not write it, although I've written a lot of business cases. And then, a little bit about my background. My PhD is quantitative oriented. It's in international business and strategy. But I have also went to the Thunderbird School and focused on international business. I'll tell you, you can guess right now, but I'll tell you later in the presentation where my area of expertise in the world is. And you could guess. You won't guess by looking at me. And then in terms of, along with Carlton and others, co-authors, published articles in International Economics and other journals. And then I'm currently serving as a dean at Utah Valley University. We're the biggest school in the West, believe it or not, in the Intermountain West, not the West completely. ASU is bigger than us. We're 47,000 students, I think, now, and much bigger than University of Utah or any in our region. So I'm a dean there, and for a lot of you, my friends out there, I was the dean at JU from 2011 to 2019. So I have Jacksonville roots and love being back here. So anyway, kudos to my friends at JU. My journey with fundraising is a little bit different than some of you out here. I was here in Jacksonville. I guess my success is other than the Mayo Clinic. I've raised the most money from the Davis family. Okay, and so most people know that. I also raised a lot of money for some of the institutions that I've worked with, and I've of course had my own startups. So I have a lot of experience asking for money in various roles. But today, we're not here about me. We're here to talk, and I've got some data, and most of the sources that I'm using are from the pitch book. And so if you have access to that resource, it's unbelievable. There's so much information that you can glean from that. And so I'm going to talk a little bit. My theme today and my talk was related to how fundraising is different today than even a year ago or 2 years ago. And we're going to look at some data together quickly in the next 5 minutes and then break for some Q&A. So one of the things I want you to look at is the trends. Now, one of the good things is that the overall value of angel deals and actually VC deals, it holds up with VC deals, is the valuations are staying pretty high. But there's a big downside to that's happened just over the last 12 months. Can you guess? Yeah, so what's happening is it just started, but the valuations, although they're high, many fewer deals are happening. Many fewer. I mean, to the point where it's a very, let's call it investment-friendly environment right now. And so I'm happy to provide some of this information, but the deal terms here it's showing are becoming more investment-friendly. So what does that mean to you as the entrepreneur? You heard in the last session and earlier to bring data to your pitch book, to your presentations, to everything that you do. And on top of that, have customers and be a lot more conscious about how you use resources, whether you bootstrap the company or you're using investment capital. For someone like me who, as a young entrepreneur, lost a lot of my hair, you could see, because I had a $400,000 payroll every month that I had to meet. And I'd go to my banker, and my banker could see over 7 years that, I was tested and bloodied in battle in, keeping my company going. This is a big change that we didn't have in 20 2020 and 2021 in terms of having to really have customers, really have a story to tell with data that you maybe didn't need as strong a one to get your company funded, no matter what stage we're talking about. So these funding challenges are even more important here. And here's the dip that I wanted to show you folks. And this is the VC deal count activity. And you've heard about it, you've read about it in the Wall Street Journal or other places. And so what I thought when I looked through all of this, and I knew I was speaking here, I wanted to get to the key question. And so I went out to about, well, I had to have about 100 folks to get about 40 people to answer the question that I wanted. And that was, I'm a little ahead of myself. This also shows the trend, see the downward trend of late stage VC funding also. This was the question that I asked, and this was a Qualtrics survey. I was so privileged to get this information. I won't tell you how I got it, but I will say they're not all Florida companies. Some of these companies are in what we call in Utah the Silicon Slopes area, okay? And so they're a combination Silicon Slopes and some Florida companies and others. They answered what success looks like for them. These companies are 3 to 5 years old. They have $5 million in sales. You couldn't be in this survey if you didn't have more than $5 million in annual sales and be less than 5 years old. If you ask these companies 2 or 3 years ago, they would have said they were going to a venture round. Now, they may be Series A or later on, but they would say that, the preponderance of them, maybe not 50%, but a lot. And I don't have, unfortunately, data from 3 years ago. I just anecdotally have that data. So there's been a big change. People have gotten religion a little bit in terms of the reality of the marketplace. So now a lot of these companies are figuring out, and I asked them, what's going to happen in the next 3 to 5 years? They're like, we're going to stay private. We're going to pay our own bills. We're going to figure things out. 35% are looking at private equity or maybe a strategic sale. And then some who either have some angel investing or are looking for more, about 22%. So big sea change from all that data that I showed you. People are figuring this out. So what are my suggestions here for all of you? How have I been successful? I haven't, I figure it this way. It's not who knows me. I mean, not who I know, but who knows me, okay? And there's a subtle difference there. Think about that. It's not just, who you know, but who knows you and who can vouch for you. So I'm going to quickly go through this because I'm running out of time. You need a great story, no matter your early stage or later. And I've got advice for you if we had time, okay, on what parts of the story you need to land in order to get someone to write a check. And fortunately, I've had times when they haven't written the check, and I've had, fortunately, a lot of times where they have. So this is Fujisan no ue ni ikeru you ni iroiro na michi ga arimasu. There are many routes to the top of Mount Fuji, right? But you have to pick your own path. And you got to figure out what you need in that backpack. And in that backpack, you need discipline in your financial management. If you've got a burn rate, treat it like a burn rate, okay? You've got to measure, learn, and practice, and have that as your regimen of your company in that backpack. Lean approach to innovation, of course, but keep innovating. You've got to keep innovating and start with a minimum viable product. So that's what I have for you today, and I think I'm out of time, actually. So I'll turn that over if there are any, maybe one question.
Yeah, I'll take one or two.
Any questions, anybody?
So I'd be curious to hear about your perspective now that you're in Utah compared to our ecosystem here that we're trying to build. How does it compare to things in Utah?
So one thing that Utah benefited from is the exodus from Silicon Valley, and it's a little far to kind of reach from Silicon Valley. And so we had Adobe move 2,000 or 3,000 employees in Utah, right next to Utah Valley in about 3 or 4 years ago. And so that, along with some big exits like Qualtrics, that's the guy who now owns the Jazz and everything else. I think there was a lot of momentum with about 5 or 6 kind of big exits, and we haven't seen that in Jacksonville. But one of the cool things we have, and I brought Carlton out, and we met some founders and looked at some startups and talked to a lot of folks. I think there's some huge advantages. The pro-business environments is similar, but the tax environment's more favorable here. I think the other thing is that there is aerospace, healthcare, and a history of financials here that I think are powerful, and they don't have that to the same degree. But they are similar, 1.3 million in Salt Lake City, and they're probably a lot more similar than Nashville or even Charlotte in terms of actual demographics. So I think it's a good comparison, and it's good to be good kind of friendly competition in between, because both have grown during the pandemic and done really, really well. So a lot of good things to say there. I think we're out of time, aren't we? So one more? There's one in the back, yeah.
Sure, Don.
Yes.
So we talk a lot about good money. Can you give us your one red flag warning tip for bad money?
Oh, man. So bad, we talked about passive versus what I call active investment. And, no investor is patient. Not a bank, no one's really patient, okay? Even if they love what you're doing. And so I think as a founder, that's something you're going to learn whether you want to or not. And so bad money is very impatient and very active investor. I put the quotes around if you want in my past history. My brother, who was partners with me at Above the Rim, he worked with the Carlyle Group and Youngkin and everybody, and that was impatient money, okay, and very, very tough situations. And so you get yourself, you be careful which poison you pick in terms of investment. And if you can go it alone, I think people say, hey, why did you sell Above the Rim after only 3 years? And we wanted it to be a global brand. And I think, then, Paul Fireman, the CEO, then made all the decisions, and it didn't become the global brand we wanted it to be. Yes, we went from apparel to shoes, but it's bad money is everywhere, and so fair warning to everyone that way. But that's a good question, Jim. Jim's a former, not only an incredibly successful. He just was up here speaking, but former doctoral student of mine in strategy and entrepreneurism at JU. So I really admire him and what he's done. So anyway, thanks everyone.